Investments in securities market are subject to market risks. Read all the related documents carefully before investing.
We have an announcement. Thanks to our clients, investors, and well-wishers who have instilled their faith in us. Our FlexiCap scheme, Solitaire, has crossed 1,000 crores in AUM. This is a remarkable milestone in our journey. Join us for the webinar on the 13th of April 2024, where we take you through the initial years of Solitaire, what made us stay the course, clients' value enhancement, and the way forward. See you there.
The difficulty of advising a small investor. I would state that the most misled person today in the social media era is the small investor, and he is misled on multiple counts. What he needs to be led never happens, and that is that he needs to have an investment program to take him towards financial goals. But what happens is he becomes so obsessed with other things that he fails to curate a program for himself that is reliable, that is validated, and that has the capability of delivering over time. What small investors do by being misled is on two fronts. One is they fail to do what they need to do, and they do what they should never do. First, what do they do which they should never do? Principally, small investors are taking a more trading oriented investment approach. That's the first thing that they should not do. The second thing a small investor should not do is make investment decisions purely on the principle of cost. As an investor, all my investment decisions were based on the benefits. Simply because there is a cost, I don't want to overlook the implicit benefits. So, being very cost driven has made investors alter their behavior significantly, because cost is driving their decisions, quality is not. So, in this cost versus quality balance, cost is taking the upper hand and quality is taking the lower hand. The third thing which an investor should not do, which they seem to be doing a lot, and this is especially true of the small investor, is be very recency driven. So, they want to buy whatever has done well in the recent past. Now, this behavior will work in a rising market. Imagine that the market falls off a cliff. Only the decisions which you made just before the market fell can bring you down significantly, because their quality would be the worst and their valuation would be the highest. Not many people are even recognizing this risk. That is why you should not carry recency bias around market highs. You must be very, very detached from recency. Small investors are not following this close enough. Okay. I have told you many things which a small investor must not do. Now to what he must do. The first thing a small investor must do is have a more balanced approach towards asset allocation. Somehow I have seen small investors have been always imbalanced in this. Earlier they used to be biased in favor of gold jewelry, then it became real estate. The most conservative guys were always in favor of fixed deposits. Now everybody is swimming at the deep end of the pool, which is equity. Nobody wants to go to the shallow end of the pool, because they think there is no thrill in swimming there. But this is not a universal thing. You need to have a balance all the time. And when one asset class becomes less attractive, you must move towards another asset class gradually. Saying I will never go near that asset class is a very extreme way of investing. And a lot of investors are making all this about their core personality. I am not like this, I will not do this, I will do only this. Investing is not just about you, it is about the environment. So, however you may be as a person, you need to adapt to the environment. Refusing to adapt brings a certain rigidity into your investing, and when you infuse too much rigidity into anything, it may become too brittle and break. So, the investor who becomes too rigid will eventually break. An investor should ensure that he brings flexibility around times like this and avoids that rigidity which will break him. So, an asset allocation approach is basically flexibility. I have been telling a lot of investors who have more money now to invest, and this is the problem. In a market high, you have more money. In a market low, you feel you don't have enough money. Somehow you find the money around the market high. That is the truth. And when you find that money, you ask, what can I do? What can I do? So, if you tell that investor, please keep this money in debt. You think, why should I put money in something which gives me 7.5%? My friends are all getting 40%. Yes, they got 40% for investing in last April. They are not going to get 40% for investing in this April. But investors are not showing the adequate flexibility to see through this. They are rigid. So, flexibility would mean that you take a more rehearsed approach towards your asset allocation and not be too rigid. That is where asset allocation is a very key need at this point in time. Another important thing an investor must do is take lesser risks in more volatile markets. When do you take higher risk? When valuations are totally in your favor, when markets are very weak, nobody wants to invest in equity. When do you reduce your risk? When everybody wants to invest only in equity. This is the progression. So, a small investor never does this. He does the opposite of it. So, I feel that what a small investor must do at this point in time is do this right. That's it. And lastly, I think knowing your risk appetite. What is your risk profile? Are you aware of your risk score? Once you are aware of all this, keep your risks lower than what is best suited to you, because you can always play to your full risk profile when the markets are in your favor, and if you do that, you are going to succeed far more than you expect, and that in turn will bring out the best behavior in you later. If we do this wrong, our behavior deteriorates. So, that is where taking lesser risks than what is your risk appetite in overvalued markets is a huge strength. I find most small investors are taking risks way above what is their risk profile and risk appetite, way above, because they are driven by return expectations which are unrealistic in the current market context. So, lower your risk, take lesser risks now, but take risks, and take more risks when they turn in your favor. And if a small investor does all this, I would think that his outcome would be what he really likes, his outcome would be better than his expectations, his outcome would beat benchmarks, and importantly, even for an investor who is obsessed about comparing himself with others, his outcome would beat his peers. Doing what is right is not simple. Doing what is wrong is relatively simple. But doing what is right is what will simplify your investing, and it will keep you away from both complexity and pain. I am sure every one of you want that, and every small investor deserves to get that. Thank you for watching this video.